Following total atomic annihilation, the rebuilding of this great nation of ours may fall to you. That's why we at Vault-Tec have prepared these educational materials for you to better understand the 7 defining attributes that make you special.
Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Cameco, ticker symbol CCJ. Cameco is one of the world's largest uranium producers, and with the growing push for clean energy, nuclear power is making a comeback. Uranium prices have been rising, and demand is expected to grow as more countries invest in nuclear energy. However, Cameco's stock is volatile due to supply chain risks, geopolitical factors, and fluctuating uranium prices. So I will say, starting off the video, I think that this company is very speculative, and I think that you could either make a ton of money or lose everything that you're putting in. I don't usually like stocks like this because the risk factor is extremely high based on the valuation, but when you actually stop to consider the fact that nuclear energy is probably going to be in very high demand, as with all energy, if you think about the new AI data training, and just the increased demand for energy as a whole as more people are born, and just as we become more advanced, I think that there's just going to be more and more of a demand for different types of energy, whether that be for charging cars or, like I said before, the data centers that are being built, and just the constant demand for energy that we already have. I think that as we build more infrastructure, we're going to need to solve the issue of just energy demand with nuclear. I think that nuclear is the obvious answer. I think that people are just scared because it has a really bad rap, but I actually think that nuclear energy makes the most sense in terms of the future as a whole. However, when we look at this stock, we see that future cash flows and future expectations are very high. The company trades at an extremely high price to earnings multiple. If we look at the actual stock, Cameco currently is up 17.25% over the past year. It has a market cap of $21.37 billion and a price to earnings ratio of a staggering 262.95. The current annual dividend yield for the stock is 0.23%. So obviously they're having to reinvest into building more nuclear and maintaining their current nuclear power plants. And it makes sense that the dividend yield is not very high, just for the fact that most of their money is going back into either maintaining or building new nuclear power plants and investing into the future growth of the company. If we stop to look at the analyst forecasts and what analysts think of the stock, 4 analysts with 12-month price forecasts for Cameco stock have an average target of $66.56 with a low estimate of 60.5 and a high estimate of 80. The average target predicts an increase of 35.62% from the current stock price of $49.08, and this is obviously 1 year out. The average analyst rating for Cameco stock from 4 stock analysts is strong buy. This means that analysts believe this stock is likely to perform very well in the near future and significantly outperform the market. And I think that analysts are seeing that the future demand is going to be very high. So even though current performance doesn't necessarily reflect the price to earnings ratio that is quite honestly staggering, I think that analysts see that countries are going to have to become more comfortable using nuclear power, and there aren't a lot of companies really competing in this space. Taking a look at the weighted average cost of capital, I was very surprised because the debt ratio compared to the market cap is only 7.71% of the total value. And usually when you look at energy companies, and I think the worst offender of this, and actually the reason why I didn't like this stock, was Duke Energy, because they have almost like a 70-30 split, and most energy companies are usually 50-50 from their market cap and total debt because they're investing so much of their money into the actual energy infrastructure or just building new pipelines or power lines or whatever type of energy they're doing. They usually have to have a significant amount of debt to actually finance it. So I was very shocked to see that the market cap is so high that the total debt is so low. And I think that this makes sense because the expectations are just so heavily weighted for this stock. I calculated the cost of equity here using CAPM with a risk-free rate of 4.568% based on the current 10-year. I also added the beta of the stock being 0.89, and I have an average market return of 7%. I think that you could go either way. I think that the market's either going to perform at 7% or below, or I mean above or below, sorry. I think that this is a good average though. Other people like to use 10%. I think that this is a little bit too greedy, and I think that stocks overall have run so hot in the past couple of years that people kind of forget that 7% is usually the norm when talking about stock market returns. Now, the cost of debt after tax was 3.875%, and this obviously results in a weighted average cost of capital of 6.51% because it's going to be closer to that cost of equity because the equity is 92.29% of the total value. Now, after we've plugged that in as our discount rate, we can see the revenues here and the cash flows here. And you have pretty consistent growth of the revenues. You have some years like 2020 to 2021 where it shrunk, but it's actually amazing how much the revenues have been able to grow from this stock as an energy company. I mean, I have never seen an energy company with this kind of level of growth with a 13.79% average revenue growth over the last 5 years and a free cash flow growth rate that's actually negative, but I believe that that's skewed just because they're putting money back into the actual business. I think that it's better to actually model based off of the most recent trailing 12-month number rather than the average free cash flow, just because I think that this number, well, I know that this number is higher, and I think that it's more in line with an actual median, and that might be something that I should add to my actual model going into the future as a median value, because I feel like the averages can get very skewed at times, and a median might be better to actually project off of, but I think that the trailing 12-month is fine to project off of for this example. Currently, I have an 18% growth rate of the free cash flow, and there's still downside to this stock. So if the cash flow grows by 18% over the next 9 years on average, and we have a perpetual growth rate for the terminal value of 2.5%, the stock is still overvalued. I do understand that I think that energy is going to be a good play in the future. I think that it's undeniable that the world is going to need more energy to power everything. And I think that nuclear is a very safe option, but I don't like nuclear at the current prices that we have here. Although this market cap is relatively lower than a lot of other energy companies, I think that personally, again, none of this is financial advice. I'm not a financial advisor, but personally, I like the pipeline companies a lot more. Sure, they're not as flashy. They're way more under the radar, but they sell at a much fairer price. And I think that you're going to be in a much better position buying those types of companies than you are buying this specific company, just because expectations are so high and this stock can fall so far. I mean, it's the earnings are basically baked in for the foreseeable future. And I haven't seen something with this high of a valuation relative to the current earnings since I've looked at Tesla. I mean, Tesla is by far much worse than this company, and I think that it would be a worse buy than this company. I think that you could make a lot of money here, but I'm also not an expert on nuclear and the future of nuclear. I think that the future of nuclear is positive. So what I have to say about this company is I think that it's an excellent type of business to be involved in, but I think that the price that you're paying to get in is just simply too high. And that's kind of my analysis of it. I think if you got in at a good price and you're willing to hold, I think that expectations are going to continue to be high into the future. I don't see any reason why the price to earnings ratio would necessarily change. So I think that it's going to hold these high expectations going into the future until it finally evens out like a regular energy company. But I just think I would not want to add this to my own personal portfolio because of this high valuation, this high price that you're paying. I think that this could fall pretty significantly, but I also think that with nuclear being the future, it could also go up. And when you don't really understand fully why a stock is priced as high as it is, or you don't necessarily fully understand, in this case, nuclear energy and the future of nuclear energy at an extremely high level, I don't think that you should invest in something like that. I mean, I understand how they make money, but from my current valuation metrics, this seems like way too expensive of a stock. Let me know what you guys think in the comments section down below. I'm really interested to hear your opinions on this stock. I think it's very intriguing, but it's a little bit out of my own wheelhouse, and I think that the valuation is too high to really justify, especially for an energy company, even if it is nuclear. And I also think that the pipeline infrastructure companies are going to be a lot better buys holding into the future. That's the video. Thank you guys for watching. Hit that subscribe button. Leave a comment down below. Bye.